would also look at these kind of markups.
All right, so you're saying we might be setting the lead. Vijay Iyer, my two corporate guests, are playing it slightly politically correctly, if I may say so, and they're also giving the government a lot of leeway for the current fiscal and monetary situation we are in. You look at this objectively for me and tell me whether these margins are realistically possible. Are these on the higher side? Do you think this is fair, or do you think that even if they're on the higher side, this is the price you pay for certainty if you want safe harbor rules?
Okay, let me start with the interest number. So that defies economics, because the rate of interest you charge is a factor of the currency in which you charge it. It is not based on the source of the funds. So if today I am lending in foreign exchange, but the source of those funds are internal accruals, I still don't need to charge a rupee interest rate. I will charge what that particular currency would justify as an interest rate. So if it's a dollar denominated loan, I can charge as much as what a dollar loan would cost.
Got it.
And not just because the funds are coming from rupees, it should be 11% interest rate. So that really defies economics. Probably there's a thought on saying that probably the opportunity cost of that fund is whatever it is, but then you're not factoring in the currency risk that is being borne by this lender who's now lending in foreign exchange. Coming to the contract R&D classification, I think the classification itself is so confusing that we may probably need an IT expert to answer that question, but I can't seem to figure out what is the classification between the IT services and contract R&D.
Okay.
So the number itself is way too high at 30%, and it is probably more than what even the transfer pricing officers are doing.
Okay.
Similarly, I would think that in contract R&D for pharma, the numbers are much higher than what the transfer pricing officers are doing. They've kind of upheld cost plus 18 in the past, and not very distant past, as recent as January 2013. So to move on to 29% for contract R&D for pharma also doesn't make sense, and similarly for KPO. So these are the three numbers which are way too high.
All right, I'm going to come to you, Gayatri, with a very basic question. If the entire attempt is to reduce litigation in the transfer pricing space, do you think this is going to work? Is it going to do enough?
I certainly think that a lot of tweaking is called for. One basic thing is certainty. I mean, one of the hallmarks of a safe harbor regime. Just look at how it's been prescribed. It's for 2 years, of which 1 year is over, and half of the next year is
1 year
over.
is currently the year that's going on.
Almost half is over. So you have a retrospective situation on the other hand, and standing today, one cannot be sure. Even if, let's say, one says, okay, I'll give in to 2%. What happens to the previous years when one went for a 1% to no commission at all? Can I still, dispute? Can I still challenge? And then again, what happens after the next year? And the other one being simplicity of provisions. Let's say an assessee, once again taking the same example, says 2%, fine, files a return. The assessing officer takes it up, let's say, after a year, and then says, oh no, I don't think you quite fit into this, you aren't eligible. Then he goes back to the regular assessment. He might not have been, or if it's let's say a 30%, having accepted, even if he is not charged, he pays up tax. At the end of it, he doesn't know why did he have to pay tax in 30. Maybe in an earlier year he had paid 25. He can't defend that. He doesn't know what to do in the future. So it's all,
so these are not tweaks. This is a redesign, Gayatri. You politely called it tweaks. All right, Mr. Saha, one of the big concerns that I've come across in all my conversations is several consultants as well as tax heads telling me that will these now reasonably high operating margins be deemed as arm's length, in the months to come or in the years to come outside of safe harbors? Is that one of your key concerns?
No, I think that risk is certainly there now that these are in the public domain. As well as I am saying that since these are so blessed in a way by the Rangachari committee report, it has given a shot in the arm to the revenue by saying that, look, these are probably the best benchmarks which we should work on. And not only the revenue authorities, I would think because the committee report comes up with these rates, a lot of adjudicating authorities, including the courts, would be influenced. So therefore, definitely there will be a problem with the taxpayers now to justify something which is significantly lower than these benchmarked rates. That's for sure. Let me very quickly also talk on this corporate guarantee and intercompany loan. My sense is that the government sort of should have perhaps refrained from coming on a safe harbor at all in case of this intercorporate loan and guarantees. I think those kind of safe harbor works where the currency volatility between two countries are kept at a minimum. But given the currency volatility we have, it's very difficult to negotiate issues of the type which Vijay mentioned. So for example, while Vijay said that, if it is a foreign currency loan, it should be benchmarked with an international benchmark. But then the other concern on the Indian side is that, when you are borrowing from Indian funds, you should at least make a positive contribution out of your margin. Now, what I was quite taken aback in the Rangachari committee report is that they think, or according to that report, the entire cost of funds and the opportunity earnings around that, they premise that that should be met by the interest earnings from the loan. Now that is wrong, because in this basic economic concept of interest rate parity, the lender's return would have probably been met by the, let's say if it's a dollar loan, the dollar rate of return plus the INR depreciation against the dollar. On the corporate guarantee, perhaps, the 2%, I think there is a little bit of a rationale, considering that, again, the committee report says that most of the banks, they charge around that type of fee for any guarantee commission. So that's the benchmark which they are taking.
All right, Mr. Saha, you're picking up steam only now. Unfortunately, I'm at the end of time, so I'm going to move it on to Vijay Iyer for the verdict on these safe harbor rules.
Certainly, it's a positive move from where we were. It took us 3 years to get this out, so at least we've got something out now. We've got a pretty well-written Rangachari committee report which sets the tone for this circular. So we can talk in the context of the Rangachari committee with the government and say, look, this is what they've said. They've raised a lot of doubts about these numbers, and so like the 30% number is not there for KPOs. There is a 22% for BPOs of a certain scale. So there are some points there which we can bring it back to the table and have a discussion. I would expect some level of rationalization of this whole thing, and if that is done, I think that will be a positive move. We don't expect 100% of taxpayers to buy into the safe harbors, but even if we get 30% takers, I think that will be success.
All right, Vijay, I'm going to treat that as the closing comment. Vijay, Mr. Saha, Gayatri, thank you very much for joining me. I know there's so much more to talk about when it comes to safe harbors, but that's all the time we have on the show. With that, I'm going to take a quick break. Coming up next, will it be third time lucky for real estate investment trusts?